What if you could build real wealth without watching charts all day, stressing over markets, or making constant decisions? Welcome to the Lazy Investor's Guide to Building Wealth, where simplicity beats complexity. In this video, you'll discover set-and-forget investment strategies designed for busy people who still want financial growth. No hype, no overtrading, just smart systems that let your money work quietly in the background while you focus on your life. 1. Wealth is built by systems, not activity. Most beginners believe wealth comes from constant effort, watching markets, researching stocks, or reacting to news. However, long-term wealth is actually the result of systems that run without emotional interference. Lazy investing is built on replacing human behavior with financial structure. Instead of asking, "What should I do today?" the system already defines what happens automatically. You invest regularly, you stay invested, and you avoid unnecessary actions. The paradox is simple. The less you interfere, the more stable your results become. 2. Time in the market is the real strategy. The core principle behind lazy investing is that time matters more than timing. Markets grow in cycles, and while short-term fluctuations are unpredictable, long-term growth trends tend to move upward due to economic expansion, innovation, and productivity gains. Trying to predict when to enter or exit the market often leads to missed opportunities. Lazy investors avoid this entirely by staying invested continuously, allowing time and compounding to work without interruption. In this model, patience is not passive. It is the main investment strategy. 3. Index investing as the core foundation. A lazy investor does not try to outperform the market through individual stock picking. Instead, they participate in the entire market through index-based investing. Index funds and ETFs spread money across hundreds or thousands of companies, reducing the risk of failure from any single investment. This creates automatic diversification without effort. The goal is not to find winners, but to own the system that produces winners over time. This reduces decision fatigue and eliminates the need for constant research. 4. Automation removes emotional decisions. The biggest enemy of investing is not lack of knowledge, it is emotional behavior. Fear during market drops and excitement during market highs lead to poor timing decisions. Lazy investing solves this by automating contributions. Money is invested automatically at fixed intervals, regardless of market conditions. This removes emotional interference and ensures consistency even when investor confidence fluctuates. Over time, this disciplined automation becomes more powerful than manual decision-making. 5. Dollar-cost averaging smooths market volatility. Instead of investing a large amount at once, lazy investors use systematic investing, often called dollar-cost averaging. This means investing a fixed amount regularly, regardless of market conditions. When prices are high, you buy fewer units. When prices are low, you buy more. Over time, this averages out cost and reduces the risk of entering at bad timing. This approach removes the need for prediction entirely, which is one of the hardest parts of investing. 6. Minimal portfolio strategy reduces mental load. Complex portfolios often lead to confusion and inconsistency. Lazy investing avoids this by keeping portfolios simple and structured. Instead of managing multiple assets, sectors, or speculative investments, the focus is on a small number of diversified funds that cover broad markets. This simplicity reduces decision fatigue and ensures that the investor stays consistent over long periods without needing constant adjustments. 7. Compounding is the real engine of wealth. Lazy investing relies heavily on compounding, which is the process of earning returns on previous returns. Over long periods, compounding creates exponential growth. However, compounding only works effectively when money is left untouched. Frequent withdrawals or interruptions significantly reduce its power. Lazy investors understand this deeply. The goal is not to constantly move money, but to allow it to grow uninterrupted for years or decades. 8. Ignore market noise and short-term emotions. Financial markets are constantly influenced by news, politics, global events, and speculation. Most of these movements are short-term and irrelevant to long-term investing. Lazy investors intentionally ignore this noise. They do not react to daily headlines or temporary price changes because they understand that reacting creates inconsistency. Emotional detachment is a core skill in this strategy. Without it, even the best system can be broken by impulsive decisions. 9. Gradual wealth expansion through income growth. A lazy investment system is not static. It grows with income. As earnings increase over time, investment contributions should also increase. This creates a natural expansion effect where wealth building accelerates without changing the strategy itself. The system remains the same, but the inputs become larger. This is important because it keeps the strategy scalable without adding complexity. 10. Reinvestment strengthens the growth cycle. All returns generated through investments, whether dividends, interest, or capital gains, should be reinvested automatically. A reinvestment increases the base amount that earns future returns, strengthening the compounding cycle. This is one of the most powerful long-term wealth accelerators. Lazy investors avoid withdrawing gains unless absolutely necessary because every withdrawal breaks the compounding chain. 11. Behavior discipline is more important than strategy. Most investing failures are not due to bad strategy, but inconsistent behavior. People start strong, but abandon systems during emotional or financial stress. Lazy investing works only when the investor commits to staying consistent regardless of market conditions. The system is designed to be simple, but it still requires discipline to not interfere with it. The real challenge is not technical. It is psychological endurance. 12. A long-term horizon eliminates pressure. Lazy investing only works when viewed through a long-term lens. Short-term expectations create frustration and unnecessary adjustments. By focusing on long horizons, 5, 10, or 20 years, the investor removes pressure from short-term performance and allows natural growth cycles to unfold. This reduces stress and improves decision stability. Now you understand that building wealth doesn't require constant effort, it requires the right system. The lazy investor wins by staying consistent, automated, and patient over time. Start small, invest regularly, and let compounding do the heavy lifting. If this helped simplify investing for you, don't forget to like the video and hit the subscribe button for more practical wealth-building strategies. Now stay consistent and let your money grow quietly for you.